Good day, students. I welcome you to another edition of Scholars Universal School online classes. Alright, for this section we'll be discussing about the topic financial institutions in economics. Alright, so talking about financial institution, what do you understand by the word financial institutions? Now, if you'll agree with me that if you look at our community, if you look at what is happening today, now we have the issue of coronavirus, the pandemic. Now, you will agree with me that we have a number of people that, they don't have money. They don't have enough money to, to survive. They don't have enough money to do business. They don't have enough money to produce for themselves. And likewise, you will also agree with me that we still have some set of people somewhere that they have more than enough. They have more than enough. Now, one of the ways or one of the things that we need in our economy is to be able to get, someone that will be able to connect those that have more than enough and those that do not have enough to come together and work together in order to make a good economy. Now, because of that, we have the financial institutions. Now, when we talk about financial institutions, we are talking about some set of people. We can term them as an intermediary. When we say intermediary, we are talking about, like a middleman. Okay, let's go into what we define financial institutions to be. We said financial institutions are the intermediaries. When we say intermediaries, you're saying the middleman. That is someone that is in between some set of people. Now, which set of people are we talking about? That is, they are the intermediaries who facilitate smooth functioning. That is, one of the things they do is, they ensure that things are moving smoothly. And what are those things that they are facilitating? They are facilitating smooth functioning of the financial system by making investors, that is, those people that are ready to invest and do not have much. That is, those people that are ready to, produce. Those people that are ready to, kickstart something. And borrowers. That is, those set of people that have enough, that have more than enough. Because you'll agree with me that there are some set of people that they are into production. There are some set of people that they are into one or two things, but they do not have enough to, expand and carry out their mission. So those set of people that needs, they want to expand, they want to invest, they want to produce. They are the people we call investors. And the set of people that have enough, that are ready to, to give out. And the set of people we call borrowers. So when the financial institution comes, how they come in place is that they come in between. That is why we said they are the intermediaries. They come in between those people, that is the borrowers and the investors. There's sometimes we could say they come in between the deficit and the surplus spenders. Surplus are, people that have more than enough. And deficit are people that do not have enough. We said they are business organizations involved in holding money for individuals and institutions. Those are the other functions of financial institutions. They hold money for individuals and institutions. And also borrowing from them. The financial institution also borrow from individuals and institutions. And when they borrow to give out loans or make investments. Even the so-called financial institutions too, they borrow from them, to make investments on their own too. Those are the key things or the key functions of financial institution or what financial institution does. Now, when we talk about financial institutions, we have types of financial institutions. We have the banking financial institutions and we have the non-banking financial institutions. Now, when we talk about the banking financial institution, we are talking about the commercial banks, the central bank, the merchant banks, the development banks. And when we talk about the non-financial institution, we are talking about companies like the insurance companies, the hire purchase companies, we have the building societies, and lots more. Alright, now when we talk about the types of financial institution, I'll be laying emphasis on banking financial institution for this class. So I'll be talking particularly about commercial banks. Now when we talk about commercial banks, what comes to your mind? I'm sure we might would have been conversant, that is, will be so familiar with commercial banks, because usually we used to see most of them. You know, when we talk about commercial banks, another name for commercial banks is deposit money bank. You know, when you hear the word deposit money or the word commercial bank, what comes to your mind from the word deposit money? You know, those are the kind of bank that, you know, we go to, you deposit money, then you withdraw. You understand? So, and basically that is the major functions of commercial banks. Okay, so we said that commercial banks are financial institutions that accept deposits and other valuables from the public for safekeeping in order to make profit. So they accept deposit and other valuables, that is deposit of money and other things that are valuable to them. They accept, you know, deposit of certificates, wills, and the likes like that. And the reason why they are doing that is in order to make profit. That is, we'll get to, by the time we get to explain the features of commercial banks, you will understand how they make profit out of those deposits. Basically, what they do is they accept deposit and other valuables from the public for safekeeping in order to make profit. Now, they are mostly limited liability companies owned by individuals, institutions, or government. An example of commercial banks are, you know, as you can see from this, we have First Bank Nigeria, we have the Union Bank of Nigeria PLC, we have the Zenith Bank, we have the Access Bank PLC, we have the Wema Bank, we have the United Bank of Africa, which is the UBA, we have the Guaranty Trust Bank. You know, we have a number of them. We have the Wema Bank, you know, Echo Bank, and the likes like that. In fact, we have Providus, we have Polaris. If you make research, I'm sure you would get, in Nigeria today we have we have 21 deposit, that is 21 commercial banks. There are 21 in numbers. We have a number of them. We have Chase Bank, we have Sterling Bank, and the likes like that, Standard Chartered. So you could always make research to get the remaining banks that we have in Nigeria. But we have 21 commercial banks in Nigeria. Alright, so now what are the functions of these commercial banks? Number one, they accept deposit from the public for safekeeping. Just from the definition that I gave you earlier, and I told you, and even from their word, from the name commercial banks, from the name deposit money bank, now what they do is they accept deposits from the public for safekeeping. Another function is that they give out loans to individuals. Don't forget, while defining financial institution, I told you that they serve as intermediaries between the investors and the borrowers. And after they must have received money from the public, they would be expected to give out the loans to individuals and firms. Another functions of commercial banks is that they act as agent of payment on behalf of their customers. There's this one of the service that the commercial banks that they provide. Take for instance, you want to pay for as an individual, we want to pay for our NEPA bill, you want to pay for one thing or the other, you want to pay for some exams, you want to pay for some some utilities. Now what you need to do is, at times you might not have to be going to the bank every now and then to make those payments. At times you just tell the bank, you give them a standing instruction, they call it standing order. You can make research, you can ask about what we call standing order. Standing order is just like you're giving, from the word standing, like you're giving an instruction to the bank that, oh, hello Mr. Bank Manager, please ensure you pay this so and so money for me. Take for instance, while I was still in school, I have a number of friends that what they do is they get, their parent has made a standing order on their behalf. That is, for every 25th of the month, banks gets to pay them their pocket money, because at times, because of the activities, daddy and mommy could forget that, okay, they want to pay you money, and you could also be busy. So what they rather do is to relieve themselves of that stress of, I've forgotten to pay my children, I've forgotten to pay my son or my daughter. What they do is they go to the bank and they give the bank a standing order, that is, on this so and so date, ensure you pay my son this particular amount of money. And by so doing, they are acting as agent of payment. That is, they are paying on behalf of their customer. Another function of commercial banks is that they help in keeping valuables They help in keeping valuables like jewelry, certificates for customers, and the likes like that. And also, another function is they issue bank statement at regular intervals. You know, when we talk about bank statement, bank statement is just like it's a particular document that is usually prepared by the bank to show details of all the things that has happened in the bank, or that has happened in the account of their customers within a particular period. You know, okay, for the month of, take for instance, for the month of June, you paid money to so and so, you withdraw money from so and so ATM machine, you receive money from this, we deducted. So all those things, all the stories, everything that happened in your account would be shown on your bank statement. So that's what we call bank statement. Bank statement is usually a statement that is sent by the bank to their customers to show all the activities that has happened in the bank. So that's bank statement. So, and it is the bank has the responsibility of sending bank statements at regular intervals. You know, usually at times it is monthly. In most cases it is monthly. At times it could be quarterly, it could be annual. It depends on the negotiation. It depends on the agreement between the customer and the bank. But it is their function to usually send bank statement at regular interval. And also they act as executor of will. Now when we talk about will is, you know, a document usually prepared by someone that takes effect after the death of the person. And one of the functions of commercial bank is that, you know, someone would have a particular individual would have told the bank, okay, Mr. Bank Manager, this is my will, this is how I want my properties to be shared. Okay, that is usually the content of a will. And one of the functions of commercial bank is that they serve as trustees and they help in the execution of this will. That is, after the death of that person, okay, they come into the picture and then carry out those duties, those functions. And usually, I'm sure what you are conversant with is one of the main people that does these executors of wills are the lawyers. So that's also one of the functions of commercial banks. Now when we talk about commercial banks, you know, when you go to a commercial bank, you go to commercial bank majorly. So before you can, you know, be a customer to them, you go there to open a bank account. Now when we talk about bank accounts, there are series of accounts that you could open with a commercial bank. The first type of account that we'll be discussing today is the current account. Now from the word current account, usually this set of accounts is usually prepared or opened by businessmen and women. And this is an account on which checks are drawn. It is only when you open a current account that you'll be given a check. If you see anybody that has a check for his account, definitely that person has a current account. And it is operated by businessmen who wish to make payment through check. You know, others of these accounts are not entitled to interest but are charged commission. Now, when we talk about current account, that is, current account is a kind of account that, you know, allows the individuals, that is the owners of those accounts, to make withdrawals at free will. That is, they make withdrawals whenever they want to. There is no particular you know, restrictions. There is no restraint. That is, they can, you know, go to the bank, withdraw, because that is the essence of that account, to manage business. And they can issue check. You know, when we talk about when I say check, I'll get to explain check in my next slide. So just stay tuned. Now, when we talk about the next step, the type of bank account that you could open in commercial banks is the savings account. And the savings account is the account that most of us are conversant with. You know, savings accounts are for most people while you are in school, or you know, you get some set of bank marketers that they will walk up to you, they will ask you, they want to open an account, this, and the account they will open for you is savings. Most likely it's going to be savings account, because I mean, you're not doing any business, so I don't expect them to open a current account for you. So most likely they will be opening a savings account for you. And this is the most common form of bank account because it encourages low income earners to develop the habit of savings, and holders of this account are paid interest. They are paid interest. And also we have the fixed deposit account. we have the fixed deposit account. Don't forget now, when we talk about savings account, usually there are some banks that when you save some reasonable amount of money for some period of time, they would give you some change, like they will give you some interest. There is a particular interest rate that is given to low-income earners that are saving, to encourage them to to develop the habit of savings. So that's that for the savings account. Now for the fixed deposit account, this is the type of account that is usually operated by individuals who have excess money and are ready to put the excess in a fixed account to earn interest. Now, for this type of fixed account, the difference between fixed deposit account and savings account is that, for fixed deposit, you would be putting the money with the bank. You would come to terms with the bank. That is, you would come to an agreement with the bank that, okay, I want to fix this money. That is, I want to save this money for this period of time, and for those period of time, you will not be allowed, or you are not expected to withdraw the money, and you will have negotiated that, okay, I want to fix 1 million for probably 1 year, and they will tell you the interest that they would be paying on that money that you have fixed. That is going to attract interest now, and the interest is going to be attracting will be more, like it's going to be more than the savings account. Now, please note that you can withdraw money. That is, withdrawal is made at an agreed time, and it attracts higher interest rates. However, you can also withdraw money whenever you need it. That is, let's assume the maturity date, you have fixed money for 1 year. You started in June. Usually it's supposed to end in May. You started in June 2020 and it's supposed to end in May 2021. And let's assume you want to use the money in December. So of course you can go there and withdraw the money, but you are the one you're the one that wants to breach the agreement. Now in this case, you might not be getting the interest you are expecting. It's not as if you cannot withdraw your money, but you can withdraw your money. It's just that there will be some penalties, there will be some fines that will be that is going to be attracting. So you have to take note of that. In fixed deposit, you are fixing your money. That is, you are putting your money for a reasonable number of days or reasonable number of period, and you are not expected to withdraw your money. However, at the point when you want to withdraw your money, it's going to attract penalties. All right. So now let's move to ways that commercial banks create money. How do they create money? The first is by granting loans to members of the public and charging interest on them. By granting loans to members of the public and charging interest on them. Now, the gift loan is they would give loans to members of the public, that's people that needs money that they want to invest. They would evaluate them, they would give them money, and then they would charge interest on them. And number two is by granting overdraft to customers having current account. Now, when we talk about overdraft is when overdraft is first of all usually given to current account holders. Don't forget, we have 3 accounts. We have current accounts, we have savings, and we have fixed deposit. Now, overdraft is given to current account holders, and overdraft is when a customer is allowed to withdraw more than what he or she has in that bank account at that point in time. That is, okay, in my account, I have an account with my bank. I have a current account with my bank, and the balance in my account is 500,000 naira. And take for instance, I want to buy a new land, I want to buy some piece of land, and the land worth 1.2 million naira. That is, I'm supposed to pay 1.2 million naira. However, in my bank account, I have 500,000 naira. That is to say, I have 700,000 naira to go. So in that case, I can go to meet with my bank managers or my officials, because I'm a regular customer. I've been dealing with them for years. They can vouch for my integrity. Those are the things that the banks will check. They will check my credit profile. Am I the person that is? Will I be able to pay? Is my account functioning? And because of that, okay, if they look at all of those things and I can meet with those requirements, they can grant me overdraft. That is the ability to withdraw more than what I have in my account. That is, they cannot give me, okay, you're go and pay the 1.2 million naira. That is, they will give me 700,000 addition to my money. So that is what we call overdraft. That is, overdraft is the ability to be able to pay more than what you have in your account. So withdraw more than what you have in your account, sorry. All right. So the next, the other ways that commercial banks create money is by keeping certain percentage of their deposit with the central bank. Now, the central bank has a rule. There has a rule, that is, there's a particular rule. There's a particular percentage of deposit that the central bank has asked all commercial banks. When we talk about commercial banks, they actually sectionalize them. We have the national bank, we have the regional bank, we have regional area banks and the like. So everyone has their threshold. So we have international bank, we have the national bank, we have the regional bank. Now for international bank, there's some certain percentage of deposit that they are supposed to keep with the central bank. So by so doing, if they keep those certain percentage of, and trust me, all of those things, if they did not meet up with those requirements, that is what I'm saying. What I'm saying is, okay, take for instance, I'm Zenith Bank. Now in Zenith Bank, the old money, the old money that my customers have deposited with me is like, say, 10 billion naira. I can decide to say, okay, and central bank has given a rule that they should drop, they should keep some percentage of their deposit, maybe 1% or 10% or thereabouts. So what they are expected to do is they will look for the percentage of those deposits and save with the central bank. Central bank, they are the bank of bankers. So it is the central bank is the apex bank. We'll still be discussing about the central bank, but not in this section. We'll be discussing about central bank properly. So now they will save their some certain percentage of those money with the central bank, and those money attract they attract interest too. And lastly, by purchasing treasury bills from the government, those are that's the last means of creating money by commercial banks or deposit money banks. Now when we talk about treasury bills is usually it's a short-term loan that is granted by the government to individuals or corporate bodies. And what they used to do is like treasury bills is just like the bank is going to buy it's like the bank is going to give out loans to the government, but instead of what they would do is at the point normally treasury bills, they will go to they would buy treasury bills from the government they will give loans to the government, and that loans will attract some amount of interest. And the interest on treasury bills is usually higher than, because one of the ways to raise money is, as an individual, is either you buy treasury bills or you fix your money, fixed deposit. Now treasury bills attract more interest compared to the fixed deposit. Now one of the ways one of the ways that commercial banks create money is to purchase treasury bills from the government. That is, they are loaning or they are giving governments money, and its treasury bill is usually short term. That is, it is within a year. So in the space of 365 days, the government they could sell treasury bills to banks, and for every day the bills, which is the money attract, it's just like they are giving the bank money, and the money is attracting more interest every day by day. So that's what we mean by purchasing treasury bills. And treasury bills is usually a short-term loan, that is loan given to the government. Okay, so now let's consider the problems of commercial banks in Nigeria. Now the first problem is that majority of the commercial banks are located in urban areas. When I say the urban areas, I'm talking about developed cities. If you go to the rural areas, you won't see commercial banks. Most people that stays in the rural area would have to move down to the urban areas to get one commercial bank. And the reason why most of them do not take the risk of going to the rural areas is number one, because of security. Because we have a number of cases in Nigeria so far that for commercial banks that are located in rural areas, they get they get issues and cases of armed robbery and the likes like that. And because of for the sake of security and protection of life and properties, they usually stay in urban areas. And you have to take note of this, that if you look at some commercial banks, mostly commercial banks, if you look at some areas, you see that some particular areas are dominated by more than enough commercial banks per time. That is, if you notice that there are some commercial banks, when you check some commercial banks, you see that one or two banks will be standing close to each other. And the reason why they are doing that is because of security reasons. That even in those urban areas that commercial banks are situated, if you look at your area, if you look at the commercial banks in your area, you will notice that they are not the only ones staying there. They will be staying close to another commercial banks, because of security reasons, so that by the time they notice one thing, they'll be able to come together, they'll be able to join forces to fight against any security threat per time. And another problem of commercial banks in Nigeria is that poverty and inability of the people to save money in banks. That is, we have a reasonable number of people that are living below average in Nigeria, and before you can tell someone to go and save, or to develop the habit of saving, definitely they should have more than enough. And also another problem is high level of corruption in the banking industry. We have a number of bank officials that they are not comfortable with what they are getting, and because of that they involve in high level of corruption. That is, at times you get daddy and mommy telling you to that some set of people had called them because they want to scam them, because they want to get to steal from their bank account. So there is high level of corruption in the banking industry. However, the bank they are trying to build controls around it to be able to cover all of those things. But that is one of the problems of commercial banks. Another thing is high level of illiteracy among the people making banking operation. That is, we need some level of literacy. We need some level of understanding to be able to use commercial bank facilities, their programs effectively. Take for instance, you can transfer money, you can pay bills, you can do anything that you want to do on your phone. So high level of illiteracy would not make you know that you could do all of those things. So I really do not have to go to the bank. I really do not have to go and queue in the bank to do the transaction I want to do for the most part of it. So I can do most of what I want to do on the phone. But when I'm not when I'm illiterate, when I don't know all of these things, I would go to the bank in most cases, and those are the set of people that you see them in the banking or creating nuisance. So those are the problems of commercial banks. Another thing is government frequent interference. And take for instance, because of this coronavirus, COVID-19, if you listen to the news very well, you will notice that the Access Bank had to release most of their workers because they could not pay. And one of the things that government did was, through CBN, they released a circular asking all banks or telling them not to release any workers. So all of those things, like government interfere in the operations of commercial banks oftentimes, that at times when they are not, because when government are saying that they should not release workers, and the government is saying most of these people, they don't have what to do, they can't pay them. So there's a conflict there. So that's one of the challenges of commercial banks. Governments would say, okay, this is what they want. Then the commercial banks would be like, we don't have the capacity to do this. So those are the other problems of commercial banks. And the next one is low patronage. When there is low patronage, they won't be, they won't have enough money, because it is patronage that would, boost because if they do not have set enough number of people to save money with them, they won't have enough money to charge interest on, and that's one of the major problems of commercial banks. Another is the high interest rate on loans. Most commercial banks also get loans from CBN, and when there is high interest rate on the loans they are getting from CBN, they will find it difficult to give or grant enough loans to their own customers. And the last problem is the NPL. NPL is non-performing loans. And when we talk about non-performing loans, as a result of non-repayment of loans. Now, we have a number of people. Don't forget, I told you that one of the major ways that commercial banks, used to raise money or used to create money is through granting loans, and then they will charge interest on those loans. And we have a number of cases whereby most of these commercial banks, their loans are not repaid. Like the set of customers that get these loans do not repay or do not pay back their loans, and all of these things affect. Those are the major problems of commercial banks. All right, so we're moving to the next part, which is the check. Check is one of the major instruments that the commercial banks use, and I've explained earlier that for people anybody that you see that has checks, definitely that person has a current account. Now let's talk about checks properly. Now when we talk about check is an order check is synonymous to money. Whenever you are giving check, it's just as good as you have collected money. Now, we are saying that check is an order written by the drawer to a bank to pay on demand a specified sum of money to the person named as payee on the check. That is, okay, when we talk about check, as you can see, this is a diagram of a check. If you can see this check, this is First Bank check, and the name of the person that they wants to pay is Demo Payee Nigerian Limited. You are paying the sum of 5,725,781 naira, 2 kobo only, and 82 kobo only. So this is a check issued by the owner of the check is Platinum Stream Consulting. Is paying Demo Payee, and the date he signed this check is on 8th of August 2016. So this amount in word is what you can see in figure here. So this is a perfect example of what a check looks like. So this is as good as, okay, this person has paid Demo Payee. So this is a check. And what are the parties to a check? First of all, we have the drawer. Don't forget, when I was explaining the check, I said it's an order written by the drawer. So the drawer is the owner of the account. So the drawer in this case is the Platinum Stream Consulting, and he signs the check and orders the banks to pay to his creditors. This is the person he wants to pay. When I say creditors, I mean the person I'm owing. Creditors are the set of people I'm owing, the person I'm paying. So drawer is usually the owner of the account. Drawer is the owner of the account. Creditor is someone I'm owing. Creditor is not a party to a check anyway. I'm just telling you that, the drawer signs the check and orders the bank to pay to his creditor. In most cases, the person he wants to pay to. Now, the second party to a check is the drawee. Now, when we talk about the drawee is the bank where the check will be presented for payment. Now, in this case, the drawee is the First Bank. The drawer is Platinum. The drawee is First Bank. Now, the payee, the person I'm paying. The person I'm paying, this is the person to whom the check is made payable. All right. So now, features of check. Now, when we talk about the features of a check, the first one is it is an order to pay. The second is the amount must be specified. Now, as you can see, the amount I want to pay is specified both in words and in figures. Now, the account number of the drawer is stated. Now, if you look below, immediately above this stated, you will see some numbers. There is 011520099. So those are the account number of the drawer, because this check would automatically be linked to the account of Platinum Stream Consulting. The next one is the name and branch of the bank appears on the check. Now, if you look at this check closely, you see that this is First Bank Nigeria. Now, the branch is telling me that this check belongs to Platinum Stream Consulting, and this Platinum Stream Consulting owns an account with First Bank, and he opened that account with their Ikeja Allen Avenue. That is, First Bank will have an account as Ikeja Allen Avenue. So that is what I'm saying. That is, the name and the branch of the bank appears on the check, and also it is addressed by one person to the another. That is, Platinum is sending Demo Payee to go and collect money from First Bank. That is addressed by one person to another, and the name of the payee must be shown on the check. As you can see, I'm paying Demo Payee Nigerian Limited. Now, Demo Payee is an institute, like is a company. Demo Payee Nigerian Limited. If, let's assume I want to pay Alonge Timothy, you will see the name there. You write the name of the person you want to pay. Let's assume I want to pay to Alonge Esmond. You see the name there. So the name of the payee must be shown on the check. So this Demo Payee is the reason why you are seeing Demo Payee is because it is the name of the company they are paying. So amount must be clearly written in words and figures. As you can see, 5,725,781 naira 82 kobo only. As you can see, just the way it's written clearly in words, it's also written clearly in figures. And okay, as you can see that this check did actually typed it, so you can also use your pen just to ensure you have written all of those things clearly. And if you have any omission, that is, let's assume you made a mistake, you should clearly cross it out and sign above it. So those are the reasons. If you do not do that, they will not honor the check. So if there's any alteration on the check, they will dishonor the check. Now, I'm moving to the next part, which is the precautionary measures to be taken when drawing a check. And the first thing is the signature must be consistent. The signature on the check. Now, there's a space for authorized signatory. Yeah, we have two spaces. That is, if the account is managed by two signatories, you have to. If there's one, you can put one. That is, there's some account that it could be they could require like more than one person to sign before they can withdraw the money from the account. So, and the signature must be consistent with the signature you've registered with the bank. The second one is the drawer must sign any alteration on the check. I've explained that. The next one is the check must not be folded. Your check must not be folded. The next one is the amount must be written in words and figures. And also the name of the payee should be properly written on the check. I've explained that. And also the signature should not be easily forged, because check is your security, and if your signature could be easily forged, that means they can withdraw all the money in your account, because that is what they need. The signature should not be easily forged. So those are the precautionary measures. That is, those are the controls that you can, that must be in place when we talk about check. All right. So I've told you that whenever you did not follow all of these controls, your check could be dishonored. Now, what are the reasons for dishonoring a check? It could be, some other reasons could be insufficient fund in the account. That is, if in your account you don't have money, you have 500,000 naira in your account, and then you've issued a check of 600,000 naira. That's insufficient fund in the account. Your check could be dishonored. There is issue of irregular signature. If there is difference in figure and words, if there is an absence of date on the check, that is, if the check is not dated, or bankruptcy of the drawer, that is, the owner of the account is if the owner of the account is already declared bankrupt. Bankrupt is when a court of law declared that you do not have money to pay people you are owing. Now, before you can be declared bankrupt, they must have gone to case. You must have gone to the court of law. They must have declared that you are bankrupt, and in that case, according to the law, you are not expected to transact business with anybody. So when the drawer is bankrupt, checks of such individuals will be dishonored, and if alterations are not signed by the drawer, your check will be dishonored, and when the check is done, it will be dishonored. All right. So we have types of checks that we have bearer's checks, we have cross check, we have open check, we have traveler's check, banker's check, posited check, cross checks, and the likes like that. So I would be leaving you with this set of assignments, briefly explain the types of checks, state 5 advantages of making payment by check, because when you use check to make payments, there are many advantages attached to it. Okay, so please attend to those assignments, and I'll encourage you that you should subscribe to our channel, Scholars Universal School. Subscribe to our channel so that you will get more videos that relates to this topic. In our next class, we will continue on the financial institutions. We'll move to the other set of banks, and please like our video. Thank you, and stay safe.